You know, every single day, millions, probably billions of us do something we don't even think twice about. We tap our card, our phone, our watch, and just like that, we've paid. But that one simple tap connects us to this massive, powerful, and pretty much invisible network. Today, we're going to pull back the curtain on that network. Mastercard.
I mean, it feels instant, doesn't it? You hear the beep, you get the little confirmation, and you're off. But in that tiny split second, a whole cascade of events kicks off, zipping data around the world. So, what is actually going on behind that tap?
Well, to get a sense of the scale we're talking about, just look at this number. $8 trillion. That's how much money in purchase transactions Mastercard is expected to process in 2024 alone. I mean, that's not just a river of money, that's an ocean, and it's flowing through their network every year. It's a figure that's bigger than the entire economy of most countries on Earth. So you can think of Mastercard as this giant global toll booth. For every transaction in that $8 trillion ocean, they take a tiny little slice. But here's the real question. In a world full of scrappy fintech startups, government regulators, and fierce competition, how strong is that toll booth? How durable is that business, really? Let's dig in. All right, let's start with the bull case, the argument for why Mastercard is so dominant. This view sees the company as more than just a business. It sees it as an economic fortress, with defenses that are almost impossible to get through. And the key idea here is what's called an economic moat. It's a great analogy. Just like a real moat protects a castle from attackers, an economic moat protects a company's profits from its competitors. It's the source of its power. And according to the analysts, Mastercard's moat isn't just wide, it's enormous. And hey, don't just take my word for it. Check out the language here from the analyst, essentially unassailable. Wow, that's about as strong a statement as you can make. It basically means that trying to build a new payment network to compete with them from scratch today is, well, pretty much impossible. So what makes them so unassailable? It all comes down to this incredibly powerful, virtuous cycle called the network effect. Think about it. The more people like you and me who have a Mastercard, the more stores have to accept it, right? And the more stores that accept it, the more useful the card becomes to us. It just feeds on itself, creating this powerful lock-in that's a nightmare for any new competitor to try and break. And this chart right here, this is the result of that network effect. The global payments world is basically a duopoly. Yeah, Visa is the undisputed king of the hill, but Mastercard is the incredibly powerful number two, with a massive lead over, well, everyone else. Together, they've created this oligopoly that pretty much runs how the world pays for stuff. So, to sum up the bull case, it's this. You've got a company that's actually growing faster than its bigger rival. You've got this huge global opportunity as cash just keeps disappearing, and you've got a management team that's playing the long game, not just chasing quick profits. Okay, but no fortress is perfect. Let's flip the coin and look at the other side of the argument, the bear case. This view sees the strengths, for sure, but it focuses on the potential cracks in those castle walls. What are the threats that could really challenge this dominance? First up, the elephant in the room, Visa. So while the bulls are cheering for Mastercard's faster growth, the bears are quick to point out that in an industry where scale is everything, being a distant number two is a permanent disadvantage. It means Visa just has more muscle, more leverage with banks and merchants, and that could put a cap on Mastercard's profits in the long run. Next, let's look at that growth opportunity versus the risk it creates. The bulls see a world going cashless, and they see dollar signs. But the bears? They see that very success as painting a giant target on Mastercard's back. Their dominance brings legal challenges and huge fines. And even worse, governments can just decide to boost their own local payment systems, like we saw in China, which could lock Mastercard out of massive, growing markets. So the bears have a whole list of worries. The company's fortunes are tied directly to how much we're all spending, so if a recession hits, they feel it. The threat of regulation is always there. New tech or government-backed networks could start chipping away at their business. And, of course, the ever-present nightmare for a company built on data, a massive security breach. That's not just a technical risk, it's a huge ESG risk, because protecting our data is one of their most fundamental responsibilities. So, you've got the bull case, this unassailable fortress, and the bear case, a fortress that's constantly under siege. How does an analyst take these two competing stories and decide what the company is actually worth? Well, they do it using a tool called a fair value estimate. Now, this is not the stock price you see flashing on your screen every day. This is the analyst's best guess at the company's true underlying worth after they've weighed all the good stuff and all the bad stuff. And here is the bottom line for Mastercard. The analyst calculates its fair value at $520 a share. But at the time of this report, the stock market was selling it for over $562. So when the market price is higher than the fair value estimate, that's what it means for a stock to be overvalued. You're being asked to pay more than the analyst thinks it's really worth.
And you know what? This isn't just a Mastercard thing. When you look at its competitors, you see the same story. Mastercard is trading about 8% above its estimated fair value. Visa is 10% above, and American Express, a whopping 22% overvalued. Clearly, the market sees the power of these payment networks and is willing to pay a hefty premium to own a piece of them.
So all of this brings us to the final verdict from the analyst report. Mastercard gets a wide moat rating. That's a big stamp of approval for its competitive advantages. But it also gets a medium uncertainty rating, which is a clear nod to the fact that the risks from regulators, rivals, and the economy are very, very real. So where does all this leave us when we think about what's next? The story of Mastercard is really a story of incredible, entrenched power that is facing constant, relentless pressure. It really just boils down to this central conflict, doesn't it? On one hand, you have this business model that seems almost untouchable, a machine that just prints money, a true economic fortress. But on the other hand, it's locked in this forever war against its main competitor, against watchful regulators, and against the blistering pace of new technology. So if you walk away from this with just 3 things, let it be these. First, the network effect is one of the most powerful moats a business can have in the modern economy. Second, the whole payments industry pretty much revolves around the rivalry between the two giants, Visa and Mastercard. And finally, and this is so important for anyone interested in business, a truly fantastic company can still be a questionable investment if the price is just too high. Which leaves us with one last question to chew on. The world of payments is always changing. We're seeing buy now, pay later services explode, governments are experimenting with digital currencies, and new fintechs are popping up all the time. The battle for how we pay, for that little piece of real estate in our digital wallets, is only getting more intense. In that fight for the future, who do you think wins?